Brookfield is up roughly 5% on the day after it reported its second quarter earnings. This is the largest position in my portfolio, as I believe the business is high quality and has incredible management. So in today's video, I want to discuss Brookfield's earnings and go over everything you need to know from them. So with that being said, let's dive right into the Daniel Pronk slideshow of the day. And this starts off with Brookfield's press release about their second quarter earnings. And it says, Brookfield Corporation reports a 21% increase in distributable earnings to $4.3 billion. And they are on track to achieve record inflows of close to $150 billion in 2023, which we did kind of cover in yesterday's video. Then Nick Goodman, the president of Brookfield Corporation, says, financial performance was very strong during the second quarter, as our operations continued to generate stable and growing cash flows. We continue to differentiate our franchise with nearly $120 billion of liquidity. So the president is basically saying that it was a great quarter for Brookfield, and I agree. So now let's move on to the next screenshot. Distributable earnings before realizations increased by 21% compared with the prior year, after adjusting for the special distribution of 25% of our asset management business, which is now the BAM ticker, or Brookfield Asset Management, which trades on the public stock exchange. So in this table, they have the adjustments for the special distribution. And why I pay attention to these adjustments right now is because last year, BAM, or Brookfield Asset Management, was wholly owned by BN, Brookfield Corporation. Now that Brookfield Asset Management is its own company and a standalone ticker, some of BN, or Brookfield Corporation, the company that we're taking a look at today, some of its cash flows is now over on a different ticker. So BN doesn't own those cash flows anymore. Therefore, these adjustments right here show us how the company would have performed if the 25% spinoff of Brookfield Asset Management did occur last year. So it's not including that 25%. And when we take a look at these adjustments, we can see that the distributable earnings for this quarter were just over $1 billion, and then last year it was $881 million. This is an increase of 15% year over year. Now, in the last 12 months, we can see that Brookfield Corporation generated about $4.1 billion in distributable earnings versus about $3.4 billion last year, which is growth of roughly 20%. So the company's distributable earnings year over year are still growing and at pretty strong growth rates as well. The distributable earnings per share for the quarter was 64 cents before realizations. After realizations, the distributable earnings for the quarter was 75 cents, and in the trailing 12 months, the company has now produced $3.26 per share in distributable earnings, which we are going to use later on in the video. So moving on to the next screenshot, this is the operational highlights of Brookfield's different business segments for the quarter. And this says, for the asset management business, fee-related earnings increased by that 16%. Fundraising momentum remains strong with inflows of $37 billion year to date. Fee-bearing capital was $440 billion as of June 30th, 2023, an increase of $48 billion or 12% over the past 12 months. And the company is projecting to raise a record of close to $150 billion in capital for the year of 2023. So very strong quarter and very strong outlook for BAM and the asset management business. Now moving on to insurance solutions. Distributable operating earnings were $160 million in the quarter and $634 million over the last 12 months. We remain on track to achieving annualized earnings from this business of $800 million by the end of 2023. So by the end of the year, the insurance solutions business should be producing $800 million of annual earnings, which is growth of another 20 to 25% from what it is producing today. With these recently announced acquisitions, our insurance solutions business will grow to over $100 billion of assets and the earnings base to a stabilized run rate of approximately $2 billion annually. So Brookfield is currently undergoing 2 different insurance acquisitions to expand its insurance business. And when these acquisitions are done, the insurance segment of the business should be producing about $2 billion of annual earnings. So it's growing incredibly well. And they are plowing a lot of capital into growing the insurance business right now. Moving on to the operating businesses. The operating funds and operations within our renewable power and transition and infrastructure businesses increased by 23% over the past year. Strong leasing momentum within our real estate business drove net operating income growth of 8% in our core portfolio as well. So overall, every segment of the business seems to be performing pretty well over at Brookfield, which is a good thing to see. Moving on to the next screenshot, it shows us the distributable earnings produced by the different business segments. So the asset management segment produced $604 million in distributable earnings this quarter versus $768 million last year. This is not on an adjusted basis. So last year they had the entire BAM ticker within BN, and now they do not have that. If they did, the company would have produced around $805 million in distributable earnings this year, which is growth of about 5 to 10%. So this business is in fact growing. It's just that BN, Brookfield Corporation, does not own the entire business anymore. Then moving on to insurance solutions, it produced earnings of $160 million on the quarter, which is up 4x from the $46 million that they generated last year. So the insurance business is growing quite strong. Now, the next underline that I have here is the Brookfield Property Group, which is the company's real estate segment. It only produced distributable earnings of $196 million this quarter, which is down year over year by about 10% from the $218 million they generated last year. In the last 12 months, the business has also generated about $780 million of distributable earnings versus $921 the prior year. So the distributable earnings and cash flow from the real estate segment is in fact declining right now. And this is because as interest rates have risen and Brookfield has had to refinance some of its real estate debt, those increased interest payments are harming the company's distributable earnings. They will say more on this later on in the video, but just know that right now, the distributable earnings for the real estate is going down. However, what is interesting is despite Brookfield not having the entire Brookfield asset management business and the real estate business generating less earnings year over year, the company overall still did grow its distributable earnings by about $4 million year over year, which I think is showing strength to the overall business and shows that the overall business is still growing despite those two headwinds. Now, moving on to the next screenshot, this starts to get into Brookfield Corporation's Q2 investor presentation. And what I have underlined here is the distributable earnings before realizations adjusted for the special distribution. And I think that this is the best metric to focus on here because it basically shows us how much actual cash flow the business is generating before its realizations of investments that it has sold. Investments are kind of like a one-time thing that Brookfield is going to take, and the profits are not going to recur in the future once the asset is sold. And I also outlined the distributable earnings before realizations in the screenshot right here, and you can see that it is in fact growing. So the actual cash flow that the business of Brookfield Corporation generates is going up and it is growing. On a per share basis, it is also growing quite strong as well, and the company has produced $3.26 now and trailing 12 months distributable earnings per share. Now, moving on to the next screenshot, this goes over all of Brookfield Corporation's different assets and the company's net asset value. So they say right here, we recommend that you focus on the blended values as these include quoted market values. And since we have control over these assets, we believe we could liquidate them for at least these values. So Brookfield is saying that the investors should focus on the blended column right here and the blended values of their assets. So starting from the top, we can see that the target carried interest is sitting at about 25.6 billion. And the accumulated unrealized carried interest is now sitting at about 6 billion. Overall, the asset management business is sitting on $85 billion worth of assets, and it produces about $2.4 billion of cash flow on an annualized basis for Brookfield Corporation. Next, we have the insurance solutions, which is worth about $8 billion right now, and is producing about $725 million in annualized cash flow for Brookfield now as well. Then down here, we have all of the different operating businesses. So for those of you who do not know, Brookfield Corporation, the ticker BN, owns massive stakes in BEP, BIP, BPU, and BPG. You can see all of the share counts right here, and this is the quoted value of all of these shares. So Brookfield, if they wanted to, could go out and sell all of these shares in their subsidiaries for about $44.5 billion right now. These shares also pay pretty strong dividends, and the dividend income from these shares is now sitting at about $1.4 billion annualized. So this is $1.4 billion of cash flow for Brookfield Corporation as well. In total, all of these assets add up to about $138 billion and about $4.5 billion in annual cash flow now. Now, Brookfield Corporation does have about $18 billion of debt that it is responsible for. So when we subtract that, we get a net asset value of about $120 billion. On a per share basis, this is $74.18 of net asset value. So whenever we hear Bruce Flatt or other management of Brookfield saying they believe their shares are massively undervalued right now, this is why. It's because they believe the net asset value for the stock is $74 a share. And I believe that it is trading for about $34 today, or about half of net asset value. Now, moving on to the next screenshot right here, this is the company's annualized cash flow. As we just saw, it is about 4.5 billion as of today. And in 2022, it was 3.1 billion. And then in 2021, it was 2.1 billion. So the company has more than doubled its annualized cash flow in just 2 years. And they are projecting to grow their cash flow by about 20 to 25% over the next 5 years all the way out to the end of 2027. So the company is producing a substantial amount of cash flow and is projected to grow this cash flow at a very strong rate over the next 5 or so years. But moving on to the next screenshot, this talks about the corporation's debt, which I do think is important to cover because I get asked about this all of the time. So this says, virtually all of the debt within our business is issued by entities or assets within the funds or other investing entities that we manage and generally has no recourse to the corporation. Only 6% of our consolidated debt is issued by or has recourse to the corporation. So if you ever take a look at BN's balance sheet, you're going to see massive amounts of liabilities and massive amounts of assets. Something like $400 billion of liabilities on the company's balance sheet. Here they are saying that this debt is not actually recourse to Brookfield Corporation or the ticker BN. Only 6% of it Brookfield Corporation is actually liable for. And all of the rest of the debt is held by other entities that again has no recourse to Brookfield Corporation. However, due to the GAAP system and how they have to report in their SEC filings, they have to show all of those liabilities and those assets even though they are non-recourse to Brookfield Corporation, which inflates their numbers massively. And then in their own investor presentation, which we are currently taking a look at, they show you how much debt the company is actually liable for and how their assets all work. So that is what I focus on personally as a Brookfield investor. And here we can see that Brookfield Corporation actually has about $15.8 billion of debt that they are liable for. All right, now this next screenshot is getting into the shareholder letter that Brookfield puts out every single quarter. And I think that these are the most valuable pieces of information for investors. So let's start off right here, and we've already covered most of the top information, so I'm going to only read the bottom portion of this screenshot. Our real estate business continues to benefit from strong tenant demand for space in high quality, well-located buildings and shopping malls, with our core portfolio 96% leased. Recent leasing momentum has driven higher revenues in this core portfolio, resulting in higher growth in net operating income of 8% compared to the prior year. Higher short-term interest rates continue to impact cash flows in the near term, but we do not consider this to be materially impactful to the long-term intrinsic value of the portfolio. So the management is saying that their real estate portfolio is still 96% leased and net operating income has grown by 8% year over year. They're also saying that the higher interest rates are impacting the portfolio's cash flow in the short term, but over the long term, they do believe that this is not going to really affect the business, and that the business's fundamentals will continue to grow over the next 10 to 20 to 30 years, if not longer. Moving on to the next screenshot, this talks about the asset sales that the company has had in the quarter. And they have a few sales that they note here. The first is a portfolio of office campuses in India, which they sold for $1.4 billion, returning nearly 4x of the capital invested. Next, they sold 50% ownership in their mobile network operator in New Zealand, generating an IRR of 31% and a multiple of capital of 2.6 times. Next, they sold a portfolio of wind and solar assets in Uruguay for $312 million, implying an over 20% IRR and over 2x multiple on capital over the 6-year period hold. Next, they sold 12.5% of their US gas pipeline for an implied enterprise value of $5.3 billion, generating an IRR of over 18% and a multiple of capital of nearly 3x. This is all part of Brookfield's capital recycling program. So what they like to do is buy assets when they're beaten down or in financial stress for pretty cheap prices, and then use their management expertise to improve the company's cash flows and profitability, clean up the balance sheet, and then sell those assets once they are producing maximum cash flow once again, and then produce additional profits on the asset sale that way. And here you can see that Brookfield is very good at doing this, generating compounded annual growth rates of 20 to 30% on these asset sales. And these are big sales as well. Moving on to the next screenshot, this says, these sales provide strong support for the carrying values of our assets and the carried interest we project to realize over the next 5 to 10 years as we continue to monetize existing investments. Should we achieve the target return of each of our current private funds, the potential realized carried interest over the next 10 years is more than $20 billion to Brookfield Corporation, none of which is currently recorded in our accounts. This will also provide us with meaningful liquidity above and beyond our recurring free cash flows we generate to further enhance the value of our business. So Brookfield is basically saying that over the next decade, they are expecting to generate $20 billion of realized profits on their investments that they have right now. This is a massive amount of additional liquidity that the business is going to have just for selling off assets. Now, this next screenshot talks about Brookfield's insurance plans and what they project for the future. 2 years ago, we set out to build a leading global insurance business. We believed we had the necessary skills to earn very attractive spread earnings on assets in the insurance portfolio. A float of approximately $45 billion in annualized earnings that will be $800 million by the end of the year. At our Investor Day last year, we presented a 5-year plan for our insurance solutions business with the goal of growing it to $225 billion of assets with distributable earnings of $3 billion by 2027. In July, our insurance business solutions committed to acquire AEL, one of the largest independent scale annuity platforms in the US, with a float of approximately $50 billion today and earnings of around $400 million a year. The acquisition valued the company at roughly $4.3 billion. So Brookfield purchased AEL at a purchase price of $4.3 billion, and the company was doing about $400 million in annual earnings. This is a price to earnings ratio just under 11, which is also an earnings yield of around 9%. So that is the yield that they got on cost of this investment. However, Brookfield also got access to $50 billion of capital in this deal. And as we saw, Brookfield can invest its capital at very high rates of return, above 20% annually. So what Brookfield is planning to do is take this massive insurance float and invest it at much higher rates of return and produce strong returns on that invested capital. They basically are doing what Berkshire does by investing the float and getting high rates of return on it and growing shareholder value that way. Brookfield is now copying this, and I believe that they can execute on this plan very well over the long term. Now, moving on to the next screenshot, this talks about value versus price, and it says, "We will end this letter with a final comment on value investing as it relates to real estate. To ensure we have all comparable terms, value is what a business or asset is worth based on its future cash flows that it will generate. Price is what a business is perceived to be worth, or trades at from time to time, based on prevailing sentiment and other matters. Rarely are value and price the same thing. Quality real estate is an exceptional long-term asset class which has proven to be that over centuries. We believe that great real estate will endure and adjust, and that these interest rate increases will merely be a blip on the value of great real estate in the long term. This is one of the reasons why I love Brookfield, because they are value investors by nature. That is the culture of the entire company. And they're saying value is basically what you get, and price is what the market is currently pricing the asset for. Warren Buffett also has a great quote that says, "Value is what you get and price is what you pay." And the two can be very different indeed. Brookfield is saying the exact same thing right here, and they're saying that the value of real estate is very high and the prices of real estate right now are very low, which is providing opportunities to invest over the long term in real estate currently. Then this continues on with a quote from Howard Marks, which says, "Watch for moments when most people are so optimistic that they think things can only get better, an expression that usually serves to justify the dangerous view that there's no price too high. Likewise, recognize when people are so depressed that they conclude things can only get worse, as this often means they think a sale at any price is a good sale. When the herd's thinking is either Pollyannish or apocalyptic, the odds increase that the current level and the direction are unsustainable. Remember that in extreme times, because of the above, the secret to making money lies in contrarianism, not conformity." Howard Marks is basically saying, watch out for when people are over-optimistic and think that things cannot go down, and also watch out for times where people believe it's the end of the world and they just want to sell their assets at any price. These are the times where you can make money as a value investor and make money as a contrarian. And he's actually saying that this is the secret to making money in the markets over the long term. And again, this is coming from Brookfield's letter to shareholders, and this is their mindset on value investing and investing in general, which again is why I love this business and its investing mindset. It is important today to remember that interest rates increase once, but rental rates can keep increasing forever. This is in regards to the company's real estate portfolio, because as we saw, the earnings or the cash flow for the real estate portfolio did drop year over year due to higher interest rates. What Bruce Flatt, the CEO, is saying here in the shareholder letter is that this is a one-time event and that going forward, rental prices can continue to increase forever. So yes, in the short term, the cash flows are being affected, but over the long term, literally the next 10, 20, 30 plus years, the rental rates on these real estate assets are going to continue to go up and outweigh the one-time impact of higher interest rates that we are currently seeing. So basically, think long-term with this real estate portfolio, and over the long term, it will continue to generate more and more cash. Real estate investors like us that push through this current environment will find themselves in a very powerful position once the markets recover. In the interim, as with every cycle, we think there will be some excellent opportunities to acquire some properties on a deep value basis. And that ends our Daniel Pronk slideshow today. Now, remember, Brookfield generated about $3.26 in trailing 12 months distributable earnings or cash flow. The company is now trading for $34.55. So if we divide this by 3.26, then it means that the company is now trading for a price to cash flow or price to distributable earnings of about 10.6. And this company has doubled its distributable earnings over the past 2 years, and they are projected to continue growing by 20 to 25% annually over the next 5 years. This basically means that Brookfield is trading for an 11 price to free cash flow while also growing free cash flow by 20% annually, which I think is a pretty good deal. Also, we saw that the company has a net asset value of somewhere around $74 a share today. It is trading for about $34 today as well. So it is trading for about half of its net asset value, which is why the management says they believe that the stock is cheap. Also, I highlighted here on my channel recently that Bruce Flatt, the CEO, purchased roughly $50 to $60 million worth of shares in BN using his own capital in the open market. So the CEO of the company seems to think that the stock is very cheap as well, and he is putting tens of millions of dollars of his own money into the stock, even though he already owns about $2 billion worth. So as the stock came down, he increased his position and put tens of millions of dollars more into the stock, and I love to see that. I really love to see that from the insiders and especially from the CEO. Overall, my thoughts on the second quarter for Brookfield was that it was a great report and the company is still executing and basically doing what they said they were going to do. I also think that the stock is trading for a cheap basis relative to its cash flow, relative to its earnings, and relative to its net asset value that it is reporting. As I have said on my channel, Brookfield is one of the only stocks left in the market that I am still happy to buy, and those are the reasons why. The stock has not participated in the overall rally that the market has seen, and it's not trading at all-time highs like a lot of other stocks out there in the market. So basically, the stock is still down, it is still depressed from its all-time highs, yet the fundamentals of the underlying business, in my opinion, are continuing to grow, and that is a recipe for a great investment, in my own opinion. That's why Brookfield Corporation, the ticker symbol BN, is the largest position in my portfolio. And again, those are the reasons why I am happy to continue adding to it, even though it is the largest position in my portfolio. But with all that being said, that is going to wrap up the video, everyone. So if you did enjoy this video or you found it helpful in some way, then please remember to leave a like on it. I do my absolute best to get these videos out as quick as possible after companies report earnings and give you my objective analysis on them. So again, if you did enjoy the video, please consider leaving a like on it. And if you are new here and you want to see more content like this, then please consider subscribing to the channel as well. But with that being said, that is going to wrap up the video, everyone. So thank you so much for watching. I truly do appreciate it. And I really hope to see you all again in my next video.